The latest Delivering Alpha investor survey, which consists of the nation's leading institutional investors, top strategists, and our own CNBC contributors, we asked for thoughts on whether the Fed should hike rates. 74% of the participants said they should pause. The rest think they should hike. Nobody thinks it's time to cut rates. For his thoughts on this and the markets, let's bring in Mohamed El-Erian, Chief Economic Advisor at Allianz and President at Queen's College at Cambridge University. Mohamed, great to see you. Where did you fall in that survey?
So I think if they are serious about that 2% inflation target, then they should hike. In fact, Chair Powell told us yesterday that a majority of the FOMC expects at least, he used the word at least, 2 more hikes. So if they are serious about 2%, they should hike.
Do you think that they will have to give up 2% in some way, or acknowledge that going towards 2% or touching 2% is sufficient? I mean, it seems like, everybody talks about Jackson Hole, but Jackson Hole might be sort of a good time to sort of elaborate on that and expound their views.
So Sarah Eisen asked that question at Centra, and all 3 central bank governors, other than Bank of Japan, so ECB, Fed, and Bank of England, made it very clear they don't want to even talk about it. The problem, Melissa, and we see it in the data on a weekly basis, is that because the Fed was late, inflation has gotten embedded in the service sector. And to get to inflation in the service sector via interest rate, you undermine the goods sector. So that is the trade-off they need to make. They want to maintain optionality right now. That's why they paused at the last meeting. But let's hope that's not the muddled middle, because getting to service inflation is tricky. We saw this again in Europe today. Headline came down, but core went up. And that we are seeing as a repeated message in most of the advanced world.
Right. And then we have the sticky point of China not doing as well as some people might want, and some questions about whether Beijing will actually embark on a huge stimulus. And I ask this in the context of it being a major trading partner of Europe. And if China doesn't come out of its funk, that could really impact the odds of a recession in Europe and maybe even here, too. What are your thoughts there?
It could, and I think China's 5% inflation growth target is optimistic. But having said that, it is incredibly impressive how resilient the U.S. economy is. 2% growth in the first quarter. We're tracking this for the second quarter. And it's incredible how resilient most of the U.S. stock markets have been. You mentioned the 30% gain in the NASDAQ, 14.5% gain in the S&P, despite 2-year rates being 50 basis points higher this year, despite the curve inverting to minus 100 basis points for 2s10s. So, we have a resilient economy and we have a resilient market, despite everything that's been happening around it.
How would you make sense of this all, though, Mohamed? I mean, it sort of doesn't. If I told you at the beginning of the year that rates are going to be where they are, guess where the stock market is going to be? I don't know if many people would have said S&P 500 higher by 15%, NASDAQ higher by 30%. Would you?
And they wouldn't have. But part of the answer is in the Apple chart you had up. You had Apple up 47%. So you have a few stocks, as we know, that led this incredible surge up to about a few weeks ago. Then it broadened out. And those are what I call either secular theme stocks, like the AI stocks, or all-weather stocks, like Apple. And now it's broadening. So you had that impact. And then you had the other thing is that all the people who have been predicting recession, I'm not one of them. I've come on your channel over and over again saying, I don't see why the U.S. needs to fall into recession unless there's a policy mistake. But all those people who have been predicting recession have been proven wrong. The U.S. economy is much more resilient than people are willing to acknowledge.
So you think that the Fed can go towards or move in the right direction of 2%, and the markets can still go higher, and we do not have a recession? It seems like that's just too good to be true.
So I think if they insist on 2%, which means going after service inflation hard, they could undermine all this. If, however, they're willing to tolerate a 3 to 4% inflation rate, provided it's stable, then you can maintain this. They're going to have a difficult choice to make. And so far, they've told us they don't want to even talk about changing that 2% target. But that is what they're going to face internally. They've got to have to confront this issue. as to how much do you want to bash the goods side, the manufacturing side, to get to your service inflation, because that is the problem right now.
Mohamed, how much should we be paying attention to the weakness in the yen, which is, at a 7-month low against the U.S. dollar at this point, and the impact that a yen carry trade is having on inflating asset prices here and elsewhere, for that matter?
So what we're seeing happening in the yen, with the yen nearly 145 versus the dollar, is a function of interest rate differentials. As you know, Japan implements this very strange yield curve control, keeping the 10-year below 50 basis points, and the rest of the world is seeing rates go higher. Look, it doesn't matter to us as long as they can exit yield curve control in an orderly fashion. And they've been waiting and waiting, and the longer they wait, the harder it is. It's like a fixed exchange rate. Everybody knows you have to exit, and the longer you wait, the harder it is to exit. So the big question for us will be, can they eventually exit the YCC policy regime in an orderly fashion? And the jury's out of this. We simply don't know. We have not seen this happen before.